Hey there, welcome to Snowpal's Polyglot Software Development Podcast. In this podcast, we're going to not talk about anything technical. Our typical podcasts are in the space of software development, but we also do, podcasts that are outside that realm. That's one of the reasons I think it keeps me excited is I try to pick topics that are sort of quite varied and the ones that I'm not particularly very familiar with, even in the space of engineering, right? There's plenty of things I don't know, but at least if it's software engineering, I have some idea, hopefully, about it, having done this for a bit. But other areas outside of that is even lesser knowledge. Investments, I have some sense, I think. I hope, given that I've spent a bit of time doing it. But it's another topic that's of interest, and plus, some of our APIs that we are currently working on building, at least we are in the initial phases, will most likely, unless things change depending on micro and macro conditions, they might be very well be in the space of investments and finance, so to speak. We'll see how it goes, but that's just don't want to spill the beans, but that's a likely possibility. Now, coming to this podcast, I stumbled into an article earlier today, and I felt like it was worth just chatting about it, even if it's a monologue. And we are in the process of publishing a bunch of courses on our web and mobile platforms that relate to investments, like stock related courses. It's a series, essentially an ongoing series, if you will. We have a few courses completed, and they should be available shortly. So definitely, check out our courses by going to learn.snowpal.com. I'm just going to do a quick screen share here so you know where those courses are. You can find them on the web. They're very affordable courses, as you can see here, and they are also available on our mobile platform. That's just a quick introduction to courses. And given the fact that some of the recent courses were related to finance or in the world of investments, this article kind of piqued my interest, and that's what I'm going to actually talk about in this podcast. Let me do a screen share so you see that article, okay? And then we will talk about it. So this is on Market Watch. You can go to marketwatch.com, look for, and it's under investing stocks. The title is Why Warren Buffett's Advice to Be Fearful When Others Are Greedy is Timely Now. So, again, if you're investing, you probably are familiar with Market Watch. It's actually a pretty decent, we have a subscription to it as well, if memory serves me right. And when you purchase a subscription, you get some other platforms or articles or sites that you can sort of co-subscribe to in one package. At least that's what I think we did. I'm pretty sure about it. Yep. Anyways, back to this article. So there's a small introduction here. It says the Joseph effect suggests the U.S. stock market will produce a below average return over the next decade and perhaps even an outright loss. These initial lines are generally dramatic in any article, but with that said, this one did pique my interest genuinely because I didn't know that there's such a thing called a Joseph effect. I believe it's the creation of mathematician. Hopefully, I get this name more or less right. The pronunciation Benoit Mandelbrot maybe, and refers to the biblical Joseph's dream interpretation in the book of Genesis that 7 years of famine would follow 7 years of feast. I don't know about that interpretation or that reference, but I get it when I read it. So this is a chart that actually intrigued me. If you look at it from starting from 1823 all the way 200 years down here, I was hoping to pull this chart on one of the other platforms I have subscriptions to, but unfortunately that window is not available. You can go as far as like 5 or 10 years, but not beyond that. This is like 2 centuries. So what this says is that I'm going to read out some of this here and can have a quick chat about it. This tendency is evident in the US stock market, as you can see it. Oh, wait, hang on. Yep. It plots the stock market's trailing 10-year annualized inflation adjusted return. Notice the ebb and flow of stocks' 10-year returns. We're going to talk about that. Your eyes do not deceive you. The correlation coefficient between trailing 10 and forward 10 returns is a statistically significant minus 30.3%. So if you look here, starting with 1823, right, it's 20, 40, 60, 80, 100, 120, 140, 160, 180, 200 years on this chart. I wish there was a bigger representation. Yeah, maybe that makes it slightly better. Okay, so starting, whatever this number is zero, the actual return percent, sorry. Uh, let's look at this. Keep an eye on this line here. 200 years ago, it was here. Let's say that's the normalized zero starting point. 18, and between these two lines, it's a decade, right? So it's 2 decades. Each grid is 2 decades. So halfway here, just imagine a split here, which would be 1 decade. So 1823 to 1833, this was like, what is it, like just before 1823? Was it like maybe 5 years before, maybe 10? I don't know. Yeah, maybe this is 1813. And it was close to a 0%. And then 1823, I think it was like 5%. It went up by 5%. The next decade, I mean, before the end of the next decade, it went up over 10%. But then if you see at the end of the next decade, the subsequent one, it is below zero. So what this is trying to say is, if you look at this, it's like let's say we start here, there's an up above 10%, down maybe minus 2 to 3%, and again up to 10%, 0%, 11% up, and then maybe there's a little bit of up for maybe 20 years or so, 15, 20 years, and then there's a drop here. But essentially it's like starting here goes up, down, up, down, up, down, up, down, up, down, up, down, up, down. And then we are about here. If you look at this pattern, of course, you have to remember that it's 200 years. That's what, if we assume 250 trading days per year, that's basically 2,500 days for 10 years, 25,000 days, trading days for 100 years. So 50,000 trading days, right? If you take this chart, it's essentially 50,000 trading days. So they don't have a number that we can plot on a different graph, unfortunately. So we're going to have to imagine some of this. This is beautiful when you look at it. Every 20 years, you see like things seem to be going up and down at the same level. I mean, the stock market goes up and down, right? I don't want to state the obvious, but it goes up and down by almost the same number. It started at 0, went up to over 10, came down to below 0, went up to 10, back down to slightly below 0. I guess this is probably after the Great Depression, is it? 1930 or something, that things went up here, I presume. And then it dropped again. 1960s, it went up over 15%. But generally, you see the pattern. And if we extrapolate this pattern, now again, given the fact that each grid is like between two lines is 20 years, that's a long time. And there's sizable differences in the pattern, but there is a pattern regardless. Does it mean now that from 2003, it went all the way up here, 2000, maybe 13, 15-ish, and now it's starting to come down. So if you extrapolate this graph, somewhere here, you see what I'm drawing, hopefully my mouse is capturing this recording, it should come down maybe in the next 10, 15 years is what this article states. But it further goes to say, it says it's evident as you see in the chart above. It says, understand that this FX implied forecast for the stock isn't based on valuation or any of the other indicators on which market timers typically focus. What that means is this is not industry specific. This is certainly not security or stock specific. It's agnostic to all of that. This is generally how the markets performed over a 200 timeline period, which means while the fundamentals and the technicals are important, and that's what we all hope and try to go by, this chart is agnostic to it and it's not based on it, yet we see a clear pattern here. It also says it has nothing to do with the narratives that have captured Wall Street's attention. It's simply based on the tendency for periods of feast to be followed by famine and vice versa. And then you can read more about it. It talks about the 60-40 stock to bond split, the recommended split of portfolios, and what that means in the context of this chart. But let's keep our focus on this chart. I want to keep this I want to wrap up within the next couple of minutes. So if you drew the extrapolated this line here, does it mean in the next 5, 10, 12 years, you're going to see a minus 2 to 5% return? If that is the case, if you're talking the next decade or so, then some part of, I'm assuming, our investments have to account for this, even as a long-term investor, correct? And it was interesting to me, and it piqued my interest because I did not know of this effect. And you live and learn every single day. There's something or the other happening, and you learn how the market reacts to it, how you're supposed or you're expected to react to the market or not react at all, or how you end up reacting because you have certain innate tendencies that are going to drive the way you react to the market conditions. Whether you panic or you're stable, or whether you treat the ups and downs with equal respect and not react to it one way or the other dramatically, it's entirely up to you, right? Up to us as individuals. So that's what I'm trying to say. So if this comes down, and if because otherwise, if it doesn't, well, the other possibility obviously is this goes up again, and then it takes an extra decade for it to readjust. Now these patterns, if you I want to try and dig deeper into it, because while there are similarities, but you could see that there is a period here. If you take this cluster, there's probably a wider window of time where the market did not actually come down. See, it started going up in 1863. Yeah, sure, it was at 0%, and then it went up to 12, and then in the next decade or so, 1 decade, it pretty much was around that, in that space, right? It didn't change all that much, and then another 8 years go by, it then dropped below 5%, and then it went up again, right? So this pattern right here is slightly different. Maybe, you know what, I should have actually taken a screen grab and taken it to a different tool to color for this. Now that I think about it, you know what, maybe we can do that really quickly. I want to wrap this up in the next couple of minutes, but it doesn't hurt. I'm going to take this from Market Watch just to quickly draw this out. Source Edward McQuarrie Hulbert ratings. Definitely check them out. Oops, what's that? Okay. So let's just make this smaller. Okay, so what I was trying to talk about was this. Let me see. Can I get a highlighter here? Yep. Let me actually pick a thicker window. Oops. This, let me try to draw this better. Okay. This cluster here, that pattern is slightly different compared to some of the rest of them. And then I see that even here, let's pick a different color. This pattern, oops, let me draw it again, is also, it is different, right? When you look at these two, they are quite different from each other, right? I mean, we have to say that they are quite different from each other. I'm talking about this one, right? So there are differences because this one is steep. Let me go back. So it goes up above 15% and then drops below, what is it, to 0%. And that's probably between 1958 maybe to 1970, 12 years. So in that decade, you saw it come down from plus 17% to a minus 3%. That's like that 20% fluctuation. That's pretty steep, right? That's a 20% fluctuation. We didn't see that here. So there are different, you can spot differences in this pattern for sure. But that said, there are some similarities as well, clearly. The fact that there is an up and a down repeatedly and it looks reasonably similar, at least to the naked eye. Now, if you take the actual raw numbers and plot them into graphs and dig deeper, it's going to, surface something else altogether, completely understood. But just short of doing that, just taking an initial glimpse at this, it says that there is something interesting. And something interesting could very well be brewing here. So I'm actually going to delete this, get out of here. Oh, I was even sharing the screen that I thought I was sharing. Oh my goodness. Okay, let me go back. I actually, let me stop share. This is the problem when I just share a window and not the whole desktop. Okay, now you see the actual graph that I was talking about for the last 5 minutes or so. I was talking about these two patterns. The first pattern is the one where I said, well, this is one. Let me put a number to this. So one. Um, okay. And then this one is basically two. I was talking about one and two, where in two, you saw that it was plus 17%, and within the decade, it drops minus 3. So it was a 20% fluctuation. Whereas in this window here, which is starting like 1865 maybe to 1913, about 3 to 4 decades, you see that the fluctuation was plus 12 to minus, 3 to 12, about 9% in over 3.5 decades, versus 20% in a single decade. So they are dramatically different, these two clusters. So there could be those differences, but for short of those differences, if we extrapolate this line here, does it mean we can anticipate a pretty steep decline in the next 5 to 8 to 12 years? If so, then we have to sort of, plan our portfolios, and then our, depending on where you're at in your investments, whether you do a retirement planning or midlife planning or early, just starting a career, planning for the next 3 to 4 decades, you may have to account for it. Now, lots of things can change, and they do change, but this effect and the pattern seems to be agnostic to it. And the fact that in the last 200 years we can draw some similarities tells me that maybe this is fairly spot on. At least it piqued my interest. So I want to share that with you, especially because it is in the context of some of the recent courses that we are starting to publish. Hope some of it made sense, even if not all of it. Check out our other podcast by going to let me just delete this here, by going to products.snowpal.com, and then you can go to podcasts, and then you'll see all the podcasts. All of them actually at this point are free as of the time of this recording. So definitely check them out, and hopefully they help you. Thanks.